Unemployment soars, oil retreats again, and P&G makes progress. This time on Morningstar's Weekly Wrap. The jobs report was unexpectedly strong. Morningstar's Bob Johnson gives his take.
This was a nice report, and we saw decent job growth in the month of June, and we thought maybe that was just a little bit of bounce back from a bad May, and now we've got a second month of kind of above 200,000 jobs added. So that was a great number to see. It was supported by a strong government number where we added about 38,000 jobs in the local government side. So that's probably a little bit of a fluke when you see that big a number, but it was still a very nice report, especially on a month-to-month basis. Now, one thing I do want to caution, I love this report. There's a lot to love in this report. We can talk about it. But on a year-over-year basis, we've still got this same trend where we're slowing overall employment growth. You know, we started out probably at something that looked like 2.1% overall, everything in payroll growth a year ago, and now we're kind of down to about 1.7% growth. So we've slowed quite a bit there on that, and that's the thing to keep in mind. And we've got a very strong second half comparison from last year where we added some incredible numbers, especially in November. So it'll be interesting to see what happens in the second half.
As we wait to see what impact this report will have on the Fed, the Bank of England moved to cushion the Brexit blow this week by lowering rates for the first time in 7 years and launching a new quantitative easing program. Oil was in the market's focus again this week as prices retreated. Morningstar's Alan Good shares his thoughts on where prices are going.
Oil prices have retreated on concerns that high refined product inventories are signaling slowing demand while supply remains resilient. We continue to see $60 as a long-term equilibrium price, which balances supply and demand and sufficiently incentivizes U.S. production to return. However, we think it will be not until later in 2017 when production begins to increase. Despite the recent pullback in oil prices and equities, we continue to see that most oil and gas producers are currently overvalued, assuming our $60 long-term price, and see more opportunity in the independent U.S. refining space.
Senior analyst Aaron Lash thinks that there could be value in Procter Gamble after their quarterly results showed the firm continuing to make progress.
Wide moat Procter Gamble's fourth quarter results showcase the steady progress the firm is making to right its ship. Organic sales ticked up 2%, and while operating margins fell to the high teens, this reflected stepped-up spending behind both advertising as well as research and development, indicating to us that management is committed to investing behind its brands to reignite top-line growth and foster its retail relationships, supporting one aspect of its intangible asset moat source. P&G is slated to close the chapter later this year on strategic efforts to shed more than half its brand portfolio. However, despite these actions, we continue to believe that P&G operates with a portfolio of leading brands, making it a crucial partner for retailers looking to drive store traffic. In a sector where discounts are few and far between, P&G still strikes us as an attractive investment, trading at a discount to our valuation.
In case you missed it this week, Christine Benz took a look at some alternatives to Vanguard dividend growth now that that fund is closed to new investors.